That place in Madison. My twins live 7 blocks away. Are you serious? How does that happen? Well, Hannah announced to me that if he wasn't in Wisconsin, she was going to be up here. So I guess they're going to be together, whether I want it or not. See that between Mike and don't they do that and then like 20 minutes later they're sitting in the same chair watching TV? They've been pretty chatty with them. Mine would fight like cats and dogs and then they could say, walk into the room again and they're sitting on the same chair. I'm not sure if you can lean on anything before you get this.
No, that's fine. We'll leave that there.
Good.
And go from there. So good morning. We're gonna get this thing started. I am a principal with Clifton Larson Allen. I'm actually in the Milwaukee office. Background: my name is Tim Mueller. Background: I'm a recovering attorney and a CPA. I don't practice law, but I did for a little while in my younger years. My practice focus is valuation, estate planning, and forensic services. So I do a lot of valuations of closely held companies, for state tax planning, for succession planning. I assist our firm with tax audits when they do arise. I do some testimony in court for various purposes, damages and the like, and valuations as well. So this is kind of what I do. And in the next 45 minutes to an hour, what I'm going to do is talk some succession planning issues. And succession planning, closely held businesses, when I give these talks, I like interacting, but these are the kind of seminars where a lot of people are not too willing to ask a question because this is very personal to them, and sometimes they don't want to ask a question that might be uncomfortable. So if you have questions, I'll be here afterwards, or you can certainly call me, and I'd be happy to answer any questions you have, clarify anything that you might have heard. So please feel free to take advantage of that. So what we're going to talk about today, succession planning. Before you can do a succession plan and really tie it into an overall estate plan, you really need to know what the value of your business is, because that is typically the largest asset in your gross estate. Sometimes it's 80 to 90% of the value. And so if you don't know the value, or you think you know the value and you get it wrong, you can do some planning that's going to end up being inappropriate, and you may be looking yourself down the road and being very disappointed. I'm going to talk about how a business is valued, kind of at the high level. What are the key drivers of your business value? So that when you go back to your business, you can take a look and see the decisions you're making, how they might impact the value of your business. If you make a decision that you know will drive up the value for a potential sale, then you can make that decision. If you're looking at giving the shares to your children, and your goal is to not have the higher value, there are other things you can do to keep the value from going up that are also good planning strategies as well. I'm also going to talk about shareholder agreements and buy-sell agreements. Some of you, I suspect most of you, have shareholder agreements if you have multiple owners. A lot of times those agreements are very old and they're not really current with the new laws or the new strategies. Sometimes those things have information in them that when we go through them with the owners, they're very surprised at how these things would be interpreted by me as a valuator or by a court in the event of a lawsuit. So we're going to talk about what some things ought to look like in that shareholder agreement, some landmines or pitfalls that you might run into if you have some bad shareholder agreement clauses. I'm also going to talk about a very recent issue that impacts everyone that's looking to transfer their business to a family member, either by gift or sale. We've been able to take very large discounts, and we'll talk about those, against a share of stock in a closely held company for, as I said, I've been doing this for over 22 years, and we've been able to take very significant discounts against the value of shares that we move from one family member to the other. On August 4th, the IRS issued some proposed regulations under Section 2704 that attempted to change all of that. And if those regulations are finalized, which would be the earliest, early January, you could see a dramatic reduction in the discounts allowed on transfer of shares between family members. We're telling our clients that it seems like these regs are an overreach based on the legislative history, but we have to plan as though they're going to be final, because if we don't, and these are finalized in January, you're going to lose a really significant opportunity to leverage your gifting transfers to your family members. So we'll talk about that. Another thing I want to talk about, because it's succession planning, is what do you do as you get close to moving your business to the next generation and make it affordable to them to actually purchase the business and still maintain some ability to retire comfortably, because that's the goal here. So we'll talk about some strategies that will allow you to perhaps get some cash flow and reduce the value of the business so that they can pay for it at a lower value. And then lastly, I'm just going to talk real briefly about supporting and defending your value. When I started back with Clifton Gunnarsson in 1994, valuation as a really a career and as a skill set was just starting out. Before that, you could go to your accountant and they'd pull out a napkin and they'd do some numbers and they'd use that number and transfer the shares. There are now so many regulations and standards out there that that's no longer acceptable. And we'll talk about what happens if you don't have the appropriate documentation in your valuation as you transfer these shares. So I'm going to talk briefly. As I said, I've got about 45 minutes or so. And again, we'll talk pretty high level, and I'll dig in deep when I think it makes some sense. But there's really three different approaches to valuing a company. The asset-based approach is pretty simple. You take a look at your assets, you try and determine what their fair market value would be, because a lot of times your book value of your assets are greatly depreciated. So if you look at a book value balance sheet and it says your equity, which is assets minus liabilities, is $1 million, you might think your value in that, under that approach is $1 million, but likely you've got a lot of value sitting on those assets that aren't reflected in the book value. So we have to go in and look at depreciated assets, real estate, etc. And it's not very uncommon for us to increase the value of the assets dramatically, and that overall value goes up significantly. I'll tie this in a little bit later, but if your buy-sell shareholder agreement says that you're going to transfer value among shareholders at book value or 1 times book value or whatever that multiple might be, if you're using book value, you're likely undervaluing the business. And that might be your intent or your desire, but you need to understand that those book value numbers underestimate in almost all cases the value. Then we look at income-based methods. If I'm going to buy or invest in a company, I need to know what the earnings of that company are going forward, and I need to look at it from a market-based approach. When you come to a CPA firm, we do what we can to minimize the income taxes that you pay on your business. So the income tax, the taxable income line, is not necessarily what that business could produce in income if you were trying to maximize your income. What I will do as a buyer is go in and look at the income statement and determine where are these non-market related expenses, and I'll adjust them back to what I would have to pay in the marketplace, and oftentimes the income is going to go dramatically up. So I'll be able to find income in value by looking at the expenses in the balance sheet, or the income statement in the balance sheet. We can either look backwards, which is called capitalized earnings, where if you have a steady company that's got steady growth, what's happened in the couple of years before may be what's going to happen going forward. So we use that as a method to value your business. if you have a dramatically shifting company where your growth is up and down, or you're seeing some up and down in growth, and you think that looking back doesn't make sense, we'll look at forecasts going forward, and then we'll bring that value back. So there's two ways to do that. Last approach is the market-based approach. This is typically for operating entities. What we do is we go, if you're large enough, we'll go into the public sector and look at public companies. Most of our clients, that's not really the right place to look. We look at private transactions, and we have databases that have thousands and thousands of transactions. We're looking for industry-specific transactions that match or mirror your business as closely as possible, and then we narrow that down and see what they're being bought for on the market. So if they're being traded or sold at 5 times their earnings, we'll look at your company compared to them, and we'll make some adjustments. It's kind of like a real estate appraiser. You've got a 1,000 square foot ranch home. They will look for similar ranch houses. If one's 1,200 square feet, you need to adjust your price because you have a smaller home. We do the same thing in the market approach. And what we'll do then is we'll take a look at all of these, and some of them we'll dismiss because we don't have enough data or it doesn't make any sense, and we'll either pick a method for the value or we'll weight the methods depending again on the facts and circumstances. So the key valuation drivers. So if you're looking at selling this business down the road, what really is a buyer looking for? What drives the value of your business? Earnings, it seems pretty obvious. Essentially, again, we're going to look at adjusting those earnings to market to make sure that we know exactly what this business is capable of earning. There's a whole bunch of different earnings metrics that we can look at: net income, EBITDA, earnings before taxes, interest, depreciation, amortization, EBIT, cash flow, etc. I'm not going to get into the details of all that. I just want to caution you. Depending on which income metric you use, you have to match that income metric to the multiple. If you don't do that, you're going to get the wrong result. So I'm going to have a different multiple to net income. It might be 5, but I might have a smaller multiple to EBITDA, because EBITDA adds back all the depreciation and amortization. So you've got a much higher number. So you have to be careful to match apples to apples. And this is, again, somewhat subjective depending on the valuator and the business itself. So then what's the multiple? To get to a value, let's simplify it down. It's really what's your earnings going forward that you think this business is likely to replicate, and what's the appropriate multiple to apply to that business. And you take the earnings times the multiple and you have a value. So we've already talked about the earnings. We pick an earnings metric. We make sure it represents fair market value, but now we have to find the multiple. And there's a couple ways to go about doing that. You can look for publicly held companies and transaction data, and again, let's make sure that they're comparable and truly are comparable. Just as an example, if your company's 50 times larger than yours, is it really comparable? If they're trading 10 times earnings, would your company trade at 10 times earnings? Likely not. That's very important. I've done litigation cases where I've had very small companies, and the opposing expert has brought in the public company method to get a higher value, and they're using what they call comparables that are 10 to 20 times the size of the company, and that's really not comparable. You really have to make a lot of adjustments, so we would typically throw that out. Another thing, if your company that's comparable is diversified into many areas, geographically, industry related, very unlikely we can rely on that as a proxy for your company. So in a smaller company, we're not likely to use the multiple method. We're probably going to use the build-up method. When you're buying a business, you're valuing a business, again, you've got two main metrics. You've got your earnings and your multiple. The way we come up with a multiple under the build-up method is we look at, I've got money to invest. What are my alternatives in the marketplace to get a return on that money? And I will compare those alternatives to your business. And at some point, I will get a return on your business that I think equals the risk of your business. That will be the return I need to get. So how do we do that? We start, and this is clearly an older slide because we don't get treasuries at 4% anymore. But we start at the risk-free rate. If you can go out and get 4%, 2 plus now, on a treasury that's risk-free, you're going to put your money in there unless you can show that you're going to get a higher return on your business. So you're looking at risk versus return. The next thing we look at is equity risk premium, and that's really, we're looking at the Dow Jones Industrial Average, the big chip stock. What's the return on that? And typically, over the last 72 years, it's been around 11 to 12%. We're sort of in an odd time right now because our interest rates are so low that number is really almost 8 or 9%. So it sort of is a lower return threshold than we've been in many, many years. The last thing that we had these up to get to your total return required. The last one we look at is size, and we look at the Russell or the Wilshire and see what their return is over time. And they're companies that can be $100 million to $500 million in size. They're well capitalized, they're diversified, and you can get, under this example, about 15% by investing in that over time. So if I get 15% in the Russell, I'll invest my money there unless I can get a bigger return in your company, because your company, again, is going to be riskier than that universe of companies. So I'm looking for how much return do I need to get to your company and invest in your company. The last thing we look at is specific risk. So I've done the build-up, I've got your company compared to the Russell 2000 companies. Your company is more risky than theirs because you're smaller, you don't have depth of management, you have a very specific product niche, perhaps you have a customer concentration. We look at your company and figure out all of these things that are making your company more risky than they would be in the Russell 2000 environment, and we add what's called the specific risk premium. Now these three, if you look at a valuation report, these are all from databases, they're not subjective. The last one, the specific risk, is subjective, and that's based on experience and credentials. And this is where you might get two valuations from two appraisers in your business. They might be 30% off. It's likely going to be in your specific risk and your growth. And so part of what I'm trying to do here is help you understand what drives that value, and when you look at it, what's important to consider. So we add this all up, and I decide that you need a 20% discount rate of return. You need 20% return on your money to invest in your company. The inverse of a 20% return is a multiple of 5. So 1 divided by 0.2. In order to, and so if we're looking forward, we're going to use a multiple of 5 and a discount rate of 20. If we're looking backward, we basically take out growth. It's what we do. It's hard to explain. But essentially, we're looking backwards, so we take out this year's growth. We end up with a cap rate in this example of 17%. So my multiple under the cap of earnings method is 5.9. You don't have to remember a lot of that detail. Just know that by doing this, we're arriving at what I think is the right multiple for your business. 5.9 times $1 million of earnings, you have a business worth $5.9 million. That's essentially how it works. One thing I do want to point out is any significant difference in these two subjective areas, the specific risk or the growth rate, can have a dramatic effect on the value. So even though, in this example, I just increased growth by 5%, I went from 3 to 8%. That doesn't seem like a lot, but ultimately, when you run the numbers, it changed the multiple from 5.9 to 8.3. So you went from 6 to 8, so basically, you'd have $2 million more to your business just by shifting your growth rate by 5%. So you need to understand where those numbers are coming from. Like I say, growth is one of the biggest value drivers. It's long-term growth. We don't put 10% growth in our analysis because the old, rice on a checkerboard, by the time you multiply that out, you'd have the U.S. GDP in your pocket. So the growth is going to be somewhere in the 3 to 6% range. It can't be double digits, not going to happen. If it's not expected to be constant, like I said, we'll look forward and we'll do something under the DCF approach. So I showed you the growth factor before. This just shows the example at $100,000. It's basically a 40% interest in value for a 5% increase in growth rate. So what are some other key valuation drivers? I showed you that 5% specific risk rate. And if you are a very solid company and you don't have a lot of these issues, your multiple will be higher. If you have a lot of these issues or problems, then your multiple will be lower. Client concentration. I valued a company probably 10 or 12 years ago. 90% of their revenue was from one company. And they were printing money. They were making a lot of money. The owner wanted to retire, so he said, value my business, find me a buyer. So we we looked at the business and we had to basically put a lot of risk on losing that one client, because if they lose that client tomorrow, there's no revenue. So by the time we walked through this, we had a multiple of 4. So 4 times, let's say $1 million, $4 million. He was pulling in each year about $700,000 of cash flow. So he said, why would I sell this company if I can keep the cash flow for 4 years and then sell it for $4 million? I said, because you said you wanted to retire, the buyers aren't going to pay you $10, $12 million for a company that you can end up having 0 revenue in the next year. So that particular situation, the owner kept the business, he hired a manager to manage it, and he ran it for another, he's still running it as far as I know. So that was something that he made that decision. But again, cash flow is great, but you have to look at the risk of losing the cash flow. Competition, he had no competition. Thin management, they had management in place. All of these factors, when I'm looking at a business, I'm looking at your business to buy it, I'm going to go through this list and many more to determine where are the risks in your company. And all of those risks are going to drive down that multiple, and it's going to drive down the value of your business. So what you want to do is take a look at these risk factors and see, how can I get rid of these risk factors? Do I need to diversify my customer base? Do I need to diversify my product niche? Do I need to have some redundancy in my management team? That happens a lot. We tell people to do that a lot. You know, you can't depend on that same management team or even the key employees below the management team to be there. And if there's only one person that can do one job, they have the leverage. And if I'm going to buy that business, that person has to come along with the business. So I'm going to have to pay them more or do a covenant not to compete or what have you. So you can do all of that ahead of time. So when I come into the business, I see that that's taken care of. It also matters dramatically what level of control that I'm valuing. If you have over 50% control of your company, you have the ability to decide how much to pay, how much to distribute, what to invest. That value is worth significantly more than a 50%, exact 50-50 ownership, because 50% can't unilaterally make decisions. All they can do is block the other person. I like to call this one litigation waiting to happen. Because at some point, unless you're getting along forever, there's going to be a point where you're going to run into a wall. Minority interest, if you're under 50% voting or you have non-voting shares or limited partnership shares where you cannot vote on the operational aspects of the company, that interest is worth a lot less than the other 2 interests. Who among us is going to pay anything for a 20% interest in a closely held company that doesn't distribute earnings? And it's family control. I'm not going to buy that company's shares because I'm not guaranteed to get a dime back on my money. I'm the outsider, so that's worth a lot less to me than a controlling interest. And we'll talk about discounts in a minute. So if you own over 50%, does that mean that it's fully marketable? You can just take the million times 5, it's $5 million, that's what you should ask for the business, or that's what it's worth for tax purposes? No. Even if you own 100% of your business, you still have to find a buyer. It's going to take time. So we take a small discount for that lack of marketability or liquidity, even on a controlling interest. Blocking is non-controlling, as I mentioned, so there's going to be a discount for control as well as marketability, and that discount's going to be dramatically higher than we would for a control value. And lastly, of course, minority or non-voting, it's full discounts. And I think I talk about it in the slide a little later, but our discounts for lack of control can be anywhere from 5 to 20%, 25%. The marketability discount, again, could be anywhere from 5 to 35%. Effectively combined discounts for minority or non-voting shares can be upward of 40%. So if you transfer $1 of shares to your son or daughter, and we take a 40% discount, you can tell the government that share is only worth 60 cents. So you've escaped taxation on that 40% difference, that 40 cents on that share, basically through your generation and through your estate. So they're very powerful tools if done correctly. Non-voting shares may be gifted up to minority value at 100% of total non-voting shares. What does that mean? So if I'm looking at giving all of my business to my kids, but I want to maintain control because I'm that way, it's a safety feature for me. What I can do is recapitalize, and S corps can have voting and non-voting shares. That's the only difference in classes that S corporations can have. But what I can do is say I'll have 1 voting share and 99 non-voting share, And that one voting share is 100% control because the non-voting can't do anything. I can literally gift that 99% of my company at minority share value. So it's a way to move a lot of money out, a lot of value out at discounted leverage value, but maintaining control. Now there is a downside to that. If you're an S corp and you distribute, it has to be done pro rata. So if you're giving 99% of your stock to your kids, you distribute $100, they get $99 of it. Also, if you sell the company, they get 99% of the value. So this is a real transfer. This isn't something that's just done for tax purposes. One of the things that's kind of unique is what we call the swing vote. If you have 249% interest and you have a 2% interest, I just said 2% is minority, it's not worth much. This is one of the rare situations where that 2% is worth some money because you're kind of the tiebreaker. And so if you've got 2% and there's 249% owners, that's worth more to me as a buyer significantly than a 2% in a different scenario. So this is a planning opportunity. I just talked about that. It's one of the ways we can recapitalize and leverage and move value. It's very simple, not that costly to do. Just a caveat, if you have a really old buy-sell agreement, pre-1990, October 8th, I would strongly suggest you talk with someone before you modify it, because if it's done before that date, you have some special protections that basically allow you to do whatever you wanted to do before 1990 with your value. If you modify that agreement for what's considered substantial modification, you bring it into the new rules. So that's something to consider. I've run into that a few times. So I talked about value, and I know I'm going pretty quickly, but I just want to give you a sense of how that is looked at in the marketplace. So we think we have an idea of the value of the property, of the business. We're sitting now with the shareholders, and okay, what do we do to ensure that this is transferred seamlessly and satisfactorily in the event of a trigger event? What is a trigger event? Death, divorce, incapacity, leaving employment. There's all kinds of trigger events that would cause the owners of the company to want to get those shares back from that person that's experiencing that trigger event. So we're going to have a buy-sell agreement in place that activates upon any of those trigger events. Does your agreement have a fixed locked-in value for the stock of departing shareholder? And is it a closely held business with family members? One of the traps out there is, for estate tax purposes, legally, for estate purposes, if I have a buy-sell agreement that says I am paying you $1, or you're paying me, the estate, $1 for the shares, I have to sell it to you for $1. That's what the agreement says. However, if the value of those shares is $1 million, you have to pay estate tax on the $1 million, not the dollar. So you might only get $1 into the estate, but you have to pay tax on $1 million. So that's a significant issue and a significant problem if that's what your agreement says. Fair market value is the price that would change hands between willing buyer and willing seller, knowing all relevant facts. And they also say that it's a hypothetical buyer-seller. So basically, we don't get to bring in any specific characteristics of the buyer. So we don't look at a competitor coming in to buy your business. If I value your company knowing that a competitor is going to buy your business, the value is going to be higher in almost all cases, because they can leverage your business by, they can remove some overhead, they can increase their volume discounts, they can increase their margins because there's less competition. So there's a lot of reasons why a competitive, synergistic buyer would pay more than I can as someone that just comes in and buys your business. So the purpose of the business can, in some cases, dictate the value. So is fair market value defined? I just read what fair market value is, and I just told you that if you have a minority interest in a closely held company, we can and do often take discounts for lack of control and lack of marketability. If your shareholder agreement says fair market value but does not discuss discounts, I will take discounts on that interest, because that's the definition of fair market value and the case law that's reflected on that. Some appraisers will not. So there's an ambiguity there. That's a problem, again, litigation waiting to happen. If you want discounts to be applied, I suggest you specifically state that in your agreement. If you do not want discounts to be applied, again, state that in your agreement. If you're the first person out, or your family death, or for whatever reason, and you get out at 60% up to $1 because of the discounts, and you weren't expecting that, that's a big problem. You're leaving a lot of money on the table for the remaining shareholders, so you need to make sure you deal with that in your agreement. Another problem we run into is defining the revenue. Again, we talked about earnings, EBIT, EBITDA, etc. A different multiple different earnings requires a different multiple. One of the things that I run into all the time is, I will get back to that in a second, is I hear people say, well, my neighbor sold his business for 5 times EBITDA. So EBITDA, as I said, is earnings before interest, taxes, depreciation, and amortization. So you're adding back all of these expenses to get to an earnings base. So if you have $1 million of EBITDA and the multiple is 5, you have a $5 million value for your business, and people think that's what you're getting in a check. Well, EBITDA is before interest. So if you're doing a multiple to EBITDA, you are assuming a debt-free company. So if you have $2 million of long-term debt in that company, you need to take the $2 million off the $5 million. So you're going to get a check for your equity of $3 million, not $5 million. And I've had that conversation. People get very surprised by that. You need to be careful as to what your metrics are and what your multiples are. Do you adjust for market-based expenses? Again, I talked about this, but if all you say is 3 times earnings, or 3 times net income, the appraiser is going to go into your audited or reviewed financials, look at your net income, and take 3 times that number. But what happens if that number doesn't reflect value? What if the owner, the 51% owner, is taking all the earnings out in compensation? And so there's literally 0 net income. The value of your company is 0, even though we know that if he or she was paying fair market compensation, the value might be several $1 million, for example. If you don't deal with that in your agreement and you talk about adjusting for market-based expenses, you're going to grossly undervalue your company. That's why it's difficult to get a shareholder agreement that tries to do a formula to really address all issues. You're going to leave something out. Another issue we run into is taxes, C Corp or S Corp taxes. For those of you that know the difference, the C Corp pays taxes at the corporate level. So the C Corp has to cut a check for taxes. S Corps are known as pass-throughs. So the income passes through to the shareholder, and the shareholders pay the tax. The IRS, when they're valuing a business, applies a 0 tax on an S Corp situation. So they're saying that if you have $1 million of income, they're 0 tax. 1 million times 5 is $5 million. That's the value of your business. If you have an exact same company that's a C Corp across the street, you take that million, you take 40% off for taxes, you have $600,000. You take $600,000 times 5, that's $3 million. The IRS says the C Corp is worth $3 million, the S Corp is worth $5 million. And they fought that tooth and nail, and we're actually in an audit right now on that very same issue. So you need to be aware that that's an issue, and there's not agreement on that. So if you want to consider taxes, which I would suggest you do, because the marketplace, when I'm looking to buy, I impute taxes because I need to know what my after-tax return is. You need to be actively talking about that in your agreement. The other thing we find is we're going to weight the last 3 years equally, or 3, 2, 1, or 5, whatever the number is. Well, what happens if you happen to be valuing this thing in 2010 or 11, and you just experienced the worst 4 years of your company's existence? If you value it based on the last 4 years of earnings, your company value is going to be really low. And that doesn't matter if you're seeing a dramatic improvement coming down the pipe. So you want to be careful that you're not doing it in either a trough or a high point, because you're going to over undervalue the company. Does it consider anomalies? Capital gains, they're in the net income number, but that's not really an operational income. That's a one-time deal. So if you went from $100,000 of income to $600,000 of income because you sold an asset, the value under that agreement might take the multiple times 600,000, grossly overvaluing your business. So I'm not trying to terrify you, but I'm just telling you, You need to understand what your agreement says. And if you're trying to do a formula, it's going to be very difficult to touch on all the different situations. This is another good one, future events. So say I've got a right under the shareholder agreement as a controlling owner to call your shares at fair market value. And I know that I've got a $100 million contract sitting out there for next year. I might be, if I'm not an honorable person, inclined to pull your shares before I get that large windfall. So you have to look and see, does it consider those types of transactions in the future? Talked about invested capital or equity. You got to look at the debt. Directors set the value. We see that in the shareholder agreements quite often. If the agreement calls for it, typically what they say is they'll meet every year, they'll set a value, and that's the value. If they don't meet every year, they don't set the value, then they go in and have to have an appraiser done. So a lot of times the directors will wing it because they don't want to have an appraisal. Again, you're in danger of over or undervaluing your company if you do it that way. Is there a floor in your agreement? This is another thing that people don't think about. Let's say you have a company that has assets of $10 million, no debt. So you have equity of $10 million in your company. Your shareholder agreement says you get paid on 3 times earnings. And let's say your earnings are $500,000. Your value of your company for your redemption is $1.5 million when you've got $10 million of equity in the company. So the first one out loses under that situation because they're going to get grossly underpaid for the value of their business. So do you have a floor that says it's got to be a minimum of book value or income? We talked about that. If you lock in a value, does it reflect fair market value? We talked about that. Sometimes, again, you're going to be stuck with that value even though for tax purposes you're going to have to use a higher value. So I've pointed out a whole bunch of problems or issues with buy-sell agreements, shareholder agreements. They're all fixable. We have checklists that walk through all of these things. These agreements need to be tailored for your specific situation. Everybody has differences in how they operate. Their income is different. Their backlog may or may not exist. You need to tailor these agreements. You can't pull one off of the internet and say this looks good. But once you have that and you've got that in place, you're going along well, you're monitoring your key drivers of your valuation. What's next? Well, what's next is you're going to, at some point, decide to transfer your business. We're talking about succession planning, so I'm assuming that means it's going to go down to the next generation. So how do you deal with that, and how does that look? If you have to have value from the business to retire, because that's 90% of your personal estate, you're going to need to get potentially maximum value for your company. So you may not be willing or able to kind of suppress the value for that transfer. You might need to maximize the value, and that's fine. You can do that. But if you have an ability to arrange some things so that you have cash flow through the business, but we can kind of keep the business value low so the next generation has a chance to do this and buy the company, that's a good thing. Depending on the value, you can do a couple of things. If you're an S corporation, as I mentioned, you have an account called a AAA account on your tax return. When a AAA account, it really just reflects as earnings that you've already been taxed on. So as an S corp earns income, it goes down to the shareholder, they pay tax on it. Sometimes you distribute all that money out and the AAA is very low. Sometimes you only distribute out enough to pay taxes. So there's this AAA account sitting there that's essentially a tax-free distributable asset. So if you have $1 million from AAA, what you can do is distribute out $1 million of asset property to your shareholder tax-free. And sometimes what you can do is you'll take on loans or debt to do that, or you'll take on some other method of getting that cash out where the value of your business, especially under an income approach, of course, would go down, because if you've taken out $1 million of assets, your equity drops by $1 million. So we look at that as a AAA that we can use. What about a deferred compensation arrangement for your key owners? This is really nice for small, closely held businesses. We use this fairly often, especially if the owner is basically retiring and they want to They want to move the value of the business to their kids, but they need a little more cash flow because they don't quite have as much in retirement as they wanted. So what we do is we set up what's called a deferred compensation plan so that on retirement, that owner gets a series of payments, say from 5 to 7 years down the road, where they get $50,000, $100,000, $150,000, whatever that number is, per year for 5 to 7 years, depending on typically what they're trying to do is get to Social Security. So that's sort of the timeline. But why do we do that? Well, first of all, it allows for that person to retire and still have a cash flow, right? Because they want to quit, but they need the money. Secondly, oftentimes the cash flow going out is less than what they were earning. So the business itself has an increase in cash flow, not a decrease in cash flow. Another advantage of that is it's deductible to the company as an operating expense. So if you buy stock from a company, you don't get the deducted, or from a shareholder, you don't get the deducted. If you pay them deferred comp plan, you get the deducted. So it's a win-win-win for everyone. The last benefit of this is you have to book that liability on your balance sheet. So if I pay someone $100,000 for 5 years, that's $500,000 of payments. The present value today of that might be $300,000. I have to put that liability on my balance sheet. What does that do? It reduces the value of the assets. So it reduces the value of the company, makes it easier for the second generation to pay for the business. Do you have non-competes with your key employees? I'm in a situation right now where one of the key employees is not under contract, and they're very, very integral to the company. Without that non-compete agreement in place, I, as a buyer, would be very, very hesitant to pay top dollar for that business. So if you have situations where you have key people in place and they're not under some sort of a non-compete agreement, you should look at that. You have to have consideration. So you have to give them something, but sometimes you can do that on an annual pay raise or something of that nature. So that's a way to lock that in and again take one of the risks off the plate on the business valuation. Another issue is stock sale versus asset sale. Again, I don't want to get too deep into the weeds, and we're getting kind of towards the end. But essentially, if you sell your stock, you pay capital gains on that. So it's 20%. So that's, and your basis is typically fairly low because you've built this business up and you've got a fairly low basis. But it's the most tax advantaged way to sell your business is typically through a stock sale. Unfortunately, most buyers want to buy the assets. And the reason for that is if I buy your stock, I take your company as is, and I also take your depreciation base inside the company as it is. So a lot of these assets are all fully depreciated. So I, as a buyer, don't get any advantage of that. So what I'm going to do is buy your assets, and I get a new cost basis in those assets. So I get to depreciate those assets all over again. So I want, as a buyer, to buy the assets. The other thing I don't want to do is buy your liabilities of your company. So if I buy your stock, if there's a liability out there that I don't know about that could cause me some litigation, I'm responsible for that. If I buy the assets, then I'm not responsible for that. You as a seller, the old company is responsible for that. So you can see there's tension here because the buyer wants an asset purchase, the seller wants a stock sale. So what we end up typically doing is running the tax scenarios under both, and we'll probably end up with an asset purchase, but we're going to move some money to the seller to make up for the fact that they no longer have that capital gains tax rate and they're paying ordinary rate on some things. So this is sort of the arm wrestling thing we do when we get down to the details. That's why you might think you've got an agreement when you say I'll buy your business for $2 million. If you haven't agreed on the structure, you don't have an agreement because they might be thinking asset purchase, you might be thinking stock purchase, and the difference in cash in your hand can be, you know, many, many percentage points. So it's something you need to do. Okay, so we talked about that. Let's talk a little bit more about the 2704 rules. I told you a whole bunch of cool things you can do about transferring shares to your kids at discounts, and that all sounds great, but then we got this big announcement August 4th basically saying if you are a closely held company, we're going to take that ability to discount for control and marketability away from you. because we don't like the fact that you're moving 40% tax-free. And they've been trying this since the Clinton presidency, and they've been losing. They've been doing it for decades. We have Revenue Ruling 9312 that essentially was 1993, that the IRS essentially said if you are gifting shares to your child under the hypothetical person standard, you don't look at what that child already owns in stock. So if I'm giving 30% of my shares to my son, and he owns 30% already, he's going to end up with 60%, which is control. I still get the value of that minority because it's a 30% block, and you look at it without considering what they already own. So I can move that at discounts. What they're saying is you can't do that. You have to consider that a transfer of a 60% interest. Actually, if the family owns 100%, it's 100% interest for control purposes, and you can't take those discounts. It's a clear overreach. I mean, I've got a white paper that we're getting through the firm approval. If you want it, I can send it to you. But basically, my conclusion is they took a little authority to what they said in the regs, where you can change or add restrictions that you can ignore. They took that ability to modify the regulations and just obliterated Revenue Ruling 9312, and I think that they're going to have some problems with that. Having said that, I can only think of one other time where they actually pulled back regs that were put out in this fashion, and that was 1989. So we're going to plan as though these regs are going to become final, but I'm cautiously optimistic that we'll be able to get them modified or withdrawn. But for now, you need to basically transfer your shares by the end of December if you want to be fully confident that you can take these discounts. So there are some exceptions. If you have non-family members that own your shares of your stock, and they, as a group, they own more than 20% of that stock, and there's a put right to that stock that says they can tell you, I want to sell my stock, and you have to pay them within 6 months pro rata value for that stock, then you don't have to consider that ownership in the control calculation. There's no one in this room or anywhere else that's going to have some non-family member with that ability to do that. They're basically saying, as a non-family member, I can walk up to you and say, give me pro rata value in cash inside of 6 months. And it's just not, it's not market reality, which is another reason we don't think this is necessarily going to go in as final. Who are members of the family? This is kind of interesting. So you've got the individual, the taxpayer that's doing the transfer, that individual spouse, any ancestor or lineal descendant, so it's up or down, brother or sister of the individuals, and then the spouses of those people. So basically, the spouses of my brothers and sisters, and my parents, grandparents, kids, grandkids. Doesn't appear to capture nieces and nephews under that definition, but really what they're saying is any of these people have ownership in your company. It's all put together to look at it. Do you have at least 50% ownership? If you do, you cannot transfer shares to your family members and take discounts under these rules. So what do you do? As I said, basically we're going to act as though these things are in play. We never let the tax rules kind of rule the day in estate planning. So if your estate isn't to the point where you can afford to comfortably move shares in a large degree before the end of the year, we're not going to suggest you do that, because you need to plan for your retirement and your cash flow needs. However, if you can do that, you were planning to do that eventually, it's something we ought to look at before the end of the year. The one thing that's still out there, and it's not clear in the regulations, is there's a 3-year look back in the new regulations that say essentially they can look back 3 years to determine ownership under certain circumstances. We don't know if that means they have to stop at the date the regulations are final. So if you did something pre-finalization, can they look at it? My sense is they wouldn't be able to do that, but it is something that's a little unclear. So Again, what they did was they took a hammer to a fly. What they were trying to do was in holding companies that hold real estate and other passive assets, they just didn't want discounts taken. So they were trying to limit that, but they ended up covering operating companies as well, and they didn't limit, they eliminated the discount. So that's a bit of a problem. Almost done. So last thing, you need to support your transaction. As I said at the beginning, we used to be able to just do a napkin 3 times multiple, here it is, put it in the file. We now have regulations and rules that basically say when you transfer for gift purposes, when you file your gift tax return, you have to adequately support the value of that gift. If you do not do that, the statute of limitations never runs on that. Now, what are the statute of limitations? All that means is if it doesn't start running, the IRS can go back all the way back to these gifts, even if it's 10 or 20 years ago, and revalue those gifts, and it can cause major problems. So what you want to do is get that statute running for federal purposes in 3 years. How do you do that? You attach what's called a qualified appraisal to the 709 gift tax return, and they have 3 years then, 4 for state, to adjust that gift. If they don't do it, and you attach a qualified appraisal, they can't go back and readjust that value. So those appraisals are not inexpensive, but they're vital for any sort of transfer of a significant nature. So there's also penalties and interest involved to the taxpayer and sometimes to the valuator. So I'm pretty cautious about that when I do that. Qualified appraiser just means you have a designation, you regularly perform these things, and you've not been prohibited from practicing in front of the service. So in conclusion, there are key valuation drivers that you can focus on to increase your value or decrease your value. Proper planning will minimize taxes that you will pay. The buy-sell agreement's very, very important, and you need to have it drafted correctly. And just know the risk areas and then be specific in your agreement. So, and finally, adequately support your values. So I'm done, a little under an hour. So any questions? All right, I'll hand it off to speaker number 2.
If anyone needs to grab another water, soda, we can get that for you. If you need to use the restroom, feel free, and we'll get you directions.
No, it should be good.
This is the